Okay, so tonight we'll be covering how the FX market itself works, some basic foreign exchange trading concepts, some of the key differences that you'll notice and experience from equity markets to the world of currency markets. There are some key differences, and a lot of the concepts are actually the same, just expressed in different ways. Once again, there's a lot of confusion surrounding the FX market, so we want to try to paint a picture of it relative to the equities markets, try to make it as clear as possible, and also highlight some of the advantages that the FX market has over other markets. And then there are some choices for getting started. A little bit about Fusion itself. So Fusion is quite new as a brand and as a product or service, you might say, but the actual organization behind it was first formed in 2002, and the team there have a huge degree of experience, not just in the currency markets and derivatives markets, but also in some of the more traditional financial products such as equities, managed products, really a very broad multi-decade combined experience there from the team. And licensed by the Australian Securities and Investment Commission with client deposits held in a secured segregated trust with Westpac, with overall, and talking more specifically about the organisation, they're very well known and highly regarded for the efficiency of execution and the overall professionalism of the service, not just from professional traders, but also from institutions, I should say. So now the Fusion company itself, or the Fusion brand itself, the Fusion service, has actually been formed to be a lot more simple and straightforward in its mission, and that is to offer global markets access via a single account. So tonight we're going to be talking, of course, about foreign exchange, currency trading, that is, but through that single account you actually do get access to some other markets as well, via CFDs, precious metals, other commodities such as crude oil, natural gas, for example, along with a handful but growing list of cryptocurrency products as well. So access to the world's major global markets all through the single account, with the MetaTrader 4 technology suite there at your disposal, with the web-based version, the desktop version, and the mobile/tablet versions there as well. So we'll take a quick look at those later in the presentation. Tonight's session really is more about the concepts themselves, but we do have another session/lesson upcoming that will focus specifically and essentially exclusively on the platforms themselves and their operation and navigation. Now, Fusion itself, in addition to everything we've discussed thus far, again talking about being very clear, simple and straightforward in its mission concept, is to provide low-cost trading, friendly support, leading technology, and that's essentially what's known as the Fusion formula. Now, when we say low cost, when I say low cost, it really is low cost. So it really is designed to significantly undercut the market averages, the industry averages out there. So while low cost is no substitute for quality, if you can have a high quality service with all the reliability of execution, security of funds, and professional support from staff as well, while improving your bottom line through lower trading fees, well, it's a great place to get started and to begin your trading journey, or perhaps start a new chapter in your trading journey if you do already have some experience. Okay, so let's talk about some of the concepts related to the actual markets themselves. Now, the foreign exchange market, also known as Forex as a contraction there, or as FX as an abbreviation, or just plain and simple currencies, or the currency markets. You hear a lot of these different terms thrown around the industry and around the webosphere, but they all are essentially the same thing. Now, what you're doing in the currency market, as distinct from, let's say, a securities market or a stock market, is you're not trading through a centralized exchange. So the ASX or the New York Stock Exchange or the Chicago Mercantile Exchange, for example, if you're looking to trade futures contracts, these are all central exchange where all the financial products therein trade. Now, with the currency market, however, you're actually looking at a global network of major banks, major institutions, hedge funds, importers and exporters, and more, all trading and exchanging currencies amongst each other all around the world, following the sun around the world on a 24-hour basis. So this, once again, is known as the interbank market, and it looks and sounds really complex, but it's not. You don't really have to worry about any of that stuff, quite honestly. All you really need to worry about is the fact that you are trading the change in value of one currency relative to another currency. And so currencies, just like everything in fact, are traded in pairs. You're trading the value of one thing relative to another thing. So there's a lot of confusion around this, a lot of mystique, and so we want to put this into some working examples. And so in this section, we'll explore understanding price quotes. Now, as you get around the place, get around the industry, you will hear the words base currency and terms currency quoted quite a lot. Now, these are economic terms. But in very simple terms, all you've really got is the base of the trade and the terms of the trade, the value of one thing relative to another thing. So we'll take an example here of the British pound as the base currency with the Canadian dollar as the terms currency. So base currency, terms currency, good to understand as a concept, but as terminologies, that's really not that important. It's a very, very simple concept. You're looking at the value of one thing versus the value of another thing. And all markets work in this way. It's by no means exclusive to currencies. It's the basis of all trade since the dawn of time. You could look at the value of cattle in Canadian dollars or the value of cattle in chickens. You could value of Facebook stock in chickens or the value of Facebook stocks relative to Twitter. It really doesn't matter. All you're really doing is you're looking at the value of one of these things, the basis of the trade, and how much of that it's actually priced in. So the actual value of that in the terms currency or the terms of the trade in this little stock example here. So sticking with the stock example using Facebook, because most people understand stocks, which is fair enough, of course. Well, with that, you are typically looking at with the in the stock market a simple, straightforward price value there. Now let's say, for example, in this case, we've got Facebook valued at $99.99 per share. If we were looking at the price of euro, for example, we might see it quoted like that, $1.12 per euro. Okay, fairly straightforward, and right now we've just got the exact same concept effectively. However, with currencies, and it's partially due to the very large volume that they trade, the very large amounts in which they transact, you don't have just two decimal places there. You don't just go down to cents. You actually go down to 5 decimal places there, 1, 2, 3, 4, 5. Okay? But the concept is, once again, exactly the same. You're looking at the value of Facebook, for example, versus US dollars. Now, again, when you look at the markets, or you look at a price quotation for a currency, it does appear confusing, but it really isn't. If you're looking at the same example on the stock exchange with a stock, you would actually see Facebook versus the US dollar. Now, it doesn't show you it doesn't actually say versus US dollar, because if you're trading on an American market, for example, it's taken for granted the fact that you're trading in US dollars. But that's actually how it would appear. It would appear as FB/USD, for example. In the currency world, it's the exact same thing. The price of one currency versus another currency. So don't get confused. The only way in which people get confused is due to the fact that we're buying and selling money with another kind of money. Okay? But it really is the exact same concept. The price of one priced in the second one, valued in the second one, base and terms. Okay, so in terms of actually trying to take advantage of this, once again, it works in the exact same way. So if you were to buy Facebook in US dollars, you would be looking for the value of Facebook relative to the US dollar to appreciate in value. And if that happens, great, you've just made some profit. The exact same thing works in the currency markets. It works in the exact same way. If you were to buy the euro versus the US dollar, you're looking for the euro to appreciate in value versus the US dollar. And it really is as simple as that. Now, obviously, the converse would work as well. If the value of Facebook versus US dollar, for example, were to depreciate in value, you would be losing money. And the exact same thing works in the currency market. If the value of the euro was to depreciate relative to the US dollar, you would be losing money. However, that's if you buy. So that's what we call going long, and it's generally what you do when you have what's known as a bullish outlook. Bullish and bearish, positive and negative, up and down. If you're bullish, you buy. If you're bearish, you sell. It's about as simple as that. So if you were to sell Facebook versus the US dollar, you would effectively be looking for the Facebook stock to depreciate in value relative to the US dollar, and in which case you would be actually profiting through that short selling mechanism there, or process. And the exact same thing works in the exact same way with the currency market. Now, in fact, it's actually easier in the currency market. We'll talk about some of the reasons why. But as confusing as it may sound, the process of short selling is as simple as instead of buying first and selling later, or buying low and selling high, you're simply selling high first with the view that you're going to buy it back later at a lower price, and therefore profit from the difference between your entry and your exit values in the exact same way, simply in reverse. The biggest thing to get your head around is the fact that depending on the broker and what it is you're trying to trade, you can actually sell something that you don't own first, so that you can then hopefully buy it back later at a lower price, and therefore profit between the differences once again. Now, with stocks, it can be difficult. It just depends on your broker and which markets you're trading, and there's a variety of reasons behind this, some of which we'll touch on a little bit later. But the point being here is that in the currency markets, you can enact the exact same process there, selling first, buying back later, but it's a very, very easy process to do because you're really just exchanging currencies and trading the values relative to one another. You can buy or sell first or second, go long, go short, just as easily as one or the other. So this is a great benefit, especially because foreign exchange markets can go through trending periods, not just upwards but downwards, along with quite a bit of consolidation. So in terms of the actual enactment of your trading strategy, if you have an effective trading strategy that gives you the ability to forecast markets and manage risk accordingly, then you can always take advantage of the market direction, so long as you can predict that sufficiently and, of course, manage your risk accordingly as well. So very, very easy to go long or short using currencies. Much, much easier than with shares, in fact. Okay, so in this section, I should say, we want to talk about understanding Forex lot sizes. So when you're trading stocks, you're looking to trade one stock at a time, two stock at a time, three stock at a time. And the value that you see of that stock is the value of your trade per stock. Now, currencies work a little bit differently, and they're actually traded in something called lots. So it sounds complicated, but it's not. The simplest explanation I can give is something that works, that we deal with on a day-to-day basis. That's the metric system there. And with the metric system, looking at length, of course, we have a base unit. So the meter is the base unit of measurement. Then we have a decimeter. Yes, that is a real word, decimeter, which is a tenth of a base unit. And then we have a centimeter, which is a 1/100th of a base unit. So really, really simple stuff there. Base unit, 1/10 of, 1/100th of. Okay. Now the exact same thing works in Forex in the exact same way. What we do is we have a base quantity, which is known as a standard lot of 100,000. In addition to that, we have mini lots, 1/10 of the base quantity, being 10,000. And then we have a micro lot, being 1/100th of the base quantity, or 1,000. Okay? Really, really simple stuff. Standard, mini, micro, base, 1/10, 100. Sorry, 1/100th. Okay? Now, what does that actually mean in terms of trading? Well, once again, if you've got your standard lot and your base quantity of 100,000, when you bring up the order ticket that we'll be looking at later, you can see that there's a quantity of 1. So when you see 1, that's your base quantity, one standard lot of 100,000. Then you have mini lots, 0.10, 1/10 of that, being 10,000. And then you have micro lots, 1/100th of the base quantity, being 1,000, 0.01. Okay? So why does this matter? Well, order quantity, of course, does matter. It matters to profitability, and of course it matters to risk. And so we want to put this into some working terms here. But first we need to understand this concept of pips. So pips is another word that you'll hear thrown around the industry continuously. And without getting too much into it, pip is just price in percentage points. Percentage in points, also known as. And as we touched on before, looking at our example of the euro there, priced in US dollars, the currency quotation is to 5 decimal places, 1.12345. Now it's actually this 4th decimal place that's known as the pip. Okay, so this is quite important to understand, because a lot of the time you'll be tracking your performance in pips, and you can also look to calculate your profit and loss on the fly using this 4th decimal place there being the pip. The 5th decimal place, by the way, is the fractional pip, sometimes called the pipette. Some people actually call the 5th decimal place the pip, so you need to be aware of that. But the way I was always taught, and I've been in this industry since 2006, is that the 4th decimal place is the pip. And so in actual dollar values, this is how it works out. So with your standard lot, you're looking at with your base unit once again. For each pip that the price changes, you're looking at a $10 profit or loss. Likewise, mini lot, 1/10, $1 per pip, like so. And with a micro lot, again, 1/100th of the base unit, 10 cents per pip, 0.01. So that's the actual profitability calculations that you can do in advance. Once again, standard, $10 per pip, mini, $1 per pip, micro, 10 cents per pip, and I use US dollars as an example there intentionally, not just because we've just talked about the Euro USD, but it is actually the second currency in the quotation of the pair, the terms currency, once again, that those values are based in. So if you have an account in another currency, not other than US dollars, then you've got to take that exchange rate into account as well. A dollar per pip is the one that we tend to focus upon, once again, because it's just very easy to calculate. And for that reason, a lot of people tend to think in terms of mini lots. Okay, 0.1 trading at $1 per pip movement. Okay. So let's talk about understanding liquidity. Liquidity is an incredibly important factor when it comes not just to trading, but actually investing at a very, very fundamental level. So liquidity really quite simply is how efficiently you can enter a trade. More importantly, however, it's actually how efficiently you can exit a trade. Very, very important. We need to take our profitability in mind. We're all out there trying to generate returns and make money from the markets, etc. But you also do need to always keep your risk in the front of your mind. And risk management is actually what's going to determine your long-term profitability anyway. So let's have a look at these in some more examples. So how efficiently you can enter a trade. Liquidity really, at the end of the day, is just the amount of buyers and sellers that you have there in the market. Okay, so the more people buying and selling and transacting and more transactions taking place means that, once again, it's easier for you to get in and easier for you to get out. So that means that in terms of the efficiency of your entry, you can get better entry prices, and therefore you can optimize your short-term profitability. Again, this is going to not just affect your profitability, but also your short-term profitability, but also your long-term profitability. But in terms of getting better entry prices, it's something you're going to notice more so on the short term, in all likelihood. And in terms of how efficiently you can exit a trade, again, this comes down to the extremely important concept of risk management. So your ability to get out of the trade when it goes counter to expectations, or if there's some market event that you weren't anticipating, which is quite a common occurrence, of course, then having the knowledge that where you set your stop loss, where you set your order to get out of the trade is likely to get executed at that price with a much higher likelihood, that is going to be a big benefit to your profitability overall, in conjunction with a proper trading strategy, proper entry criteria, and once again, better risk management overall. And so when we talk about risk management, people don't get too excited about it because it doesn't seem as exciting as getting out there and chasing the profits, trying to make the money, trying to squeeze as many pips as we can out of the market. But take it from someone who's been around for a while, and you can go and ask any professional trader you like about this. But risk management is actually what's going to determine, have a huge effect, crucial effect, I should say, upon your long-term profitability. So always think about that in terms of staying motivated for proper risk management. Is this actually your long-term profitability that you're doing this for? So liquidity, once again, is actually determined by two factors. That is time availability and size. So liquidity is, by definition, your ability to get in and your ability to get out, not just of a trading position, but as more broadly speaking, more generally speaking, of any investment opportunity. So for example, a property investment may be a great investment, but it's not very liquid because it's not very easy for you to get out of. Stocks are considered to be more liquid, much more liquid than some of the other investment products out there. But what we want to do now is we want to take a little bit of a comparison of the equities markets versus the currency markets in terms of the size. So again, liquidity is determined by time availability and by size. And so what we see here is something loosely termed as the $1 trillion club. It relates to the size of global equity markets, looking at the global equity markets around the world that are at least that $1 trillion mark. So we can see here that the Australian market, the Australian Security Exchange there down in the bottom right-hand corner, does actually make the list, but it's actually the smallest of the top 15 globally. That's okay. We've got a big country, a small population, and we're spread out all over the thing pretty much. So we're punching above our weight, but nonetheless, we are the smallest of the top 15 globally. So those of you that have a little bit of experience in the currency markets will have some idea where I'm going with this, but in order to actually compare the relative sizes there, and once again, each of those octagons that you see there are different colors represents the relative size of the exchanges around the world, with the US being the biggest, followed by some of the Asian markets there, Japan and Shanghai, followed by some of the, fairly closely followed by some of the European markets there. Then we have India and Australia down the bottom once again. But looking at the currency market on a relative basis once again, then we see something like that. So thinking back to the start of this presentation, the global currency market really is the foundation of the global economy. Everything that we do depends on international trade, international settlements, global interest rates, so on and so on and so on. So you can actually combine all of the world's equity markets and you've still only got some tenth or so of the global liquidity of the global currency market. So we're talking about a huge market here, and it's not just opening in the morning and closing in the afternoon, which is what we see, of course, with the equities markets. In the case of Australia, opening up at 10 a.m. and closing at 4 o'clock in the afternoon. Most of the exchanges around the world are like that. The currency market, on the other hand, simply follows the sun around the world. It's open 24 hours a day and only closes for a portion of the weekend. So it actually closes in the New York afternoon, which is Saturday morning for us, and reopens with the New Zealand market very early Monday morning. Okay, and throughout that time, you've actually got trading opportunities that you can take advantage of, which means that it's great for those of you that do have a 9-to-5 job. You're actually working while the stock exchange is working, and then by the time you finish work, it's already closed. Well, the currency market is there for you to take advantage of, and so that liquidity, in terms not just of size but also time availability, does equate to opportunity. It also allows you to trade with a little bit more leverage, or in fact a lot more leverage, depending on how aggressive that you want to be with your trading. And nonetheless, this liquidity and size is actually more important from a safety perspective, from a risk management perspective. Anyone who's traded stocks in the past knows that if you're trading a decent size order, you can experience slippage. You can go in for one price and not actually get that price, but end up with something worse. And moreover, much more importantly and more severely, you might say, is when the market closes at 4 o'clock in the afternoon, and then we get some bad news come out of the commodity markets. We get some bad news come out of London, perhaps, but usually more often than not, it's out of the US, which of course leads the global economy. And so the traders on the Australian Stock Exchange or the Asian exchanges are waking up in the morning and seeing what's happened on the US markets overnight, and they're factoring that into what they're prepared to pay for their stocks this morning. And so we can see a big difference between what the stock closed at 4 o'clock today and what it opens up at 10 o'clock tomorrow morning. So this is known as gapping, and due to the 24-hour Monday to Saturday morning nature of the currency markets, you just don't experience that gapping in anywhere near the same way. It's effectively trading continuously, with some exceptions in case of some anomalous events and so forth. But in terms of you getting into a trade and placing a stop loss where you want to get out, it allows you to manage your risk much more effectively. Okay. All right, so let's have a look at how to get started. Okay, so there it is. Stop paying too much to trade, and what you want to do there is you just want to go straight to this create an account button there, or you can enter your email and follow the instructions. We go to create an account. And if you already have an account, for those of you that do, you just go ahead and log in. Otherwise, create yourself a password. Confirm that you are over 18, and away you go. So what you have now is you have access to a client portal area, and what that will allow you to do is to go in and create accounts for yourself. So you can go and through this one portal area, you can have multiple accounts. A lot of people use different accounts for different strategies or signal services or whatever the case may be. And you can also, so you can create either a live account or a demo account, or both, but it's all accessed through this client portal here. So we'll just go up to this new account button here. And so this is a demo account that I set up a little while ago, and so again, we've got some presentations coming up that focus exclusively on the platform operations, but the two main ones that you have really are the web-based platform that you see here, MetaTrader 4 Web, and then you've got a desktop version. MetaTrader 4 Web is good because it's very quick and easy and a little bit simpler. The desktop version is almost the same. In fact, the layout, the interface, and the majority of the functions are exactly the same, but there are some more advanced things that you can do with it, especially on the technical analysis front and more specifically on the custom tools and algorithmic trading front there. So the desktop version, the downloadable and installable version, is actually the preferred one for the more experienced traders. But if you're just following signals or doing pretty basic stuff, then MetaTrader 4 Web is great. Once again, nice and quick and easy, and away you go. So when you see this here, when you see MetaTrader 4 and the price tickets, which is what I want to bring your attention to, as we talked about somewhat in the presentation, you see a difference between the bid and the ask. You can also see this here in the price quotes terminal here. For that, what you might need to do is go and right click and add the spread column, because what you see here is the difference between the sell price, the bid price, 1.10682, and the ask price, 1.10692, fluctuating, of course. The difference between these is the spread. Okay, so this is actually the 5th decimal place that we covered in the presentation there. So 1/10 of a pip, 2/10 of a pip, 0 pips, spread there fluctuating. Now this is what's known as an ECN account. Okay, now that's the option that you have there. ECN versus Classic. All right. And with that, the difference is actually whether or not you're going to pay brokerage, actually commission, on your trades in addition to the spread, or if you select the Classic version, there's no commission, but the spread is wider. Does that make sense? So with one, you're paying the spread only, but it's a wider spread. With the other one, you get tighter spreads. Okay, so lower cost of spread, but you pay a commission on top of that. So it really is up to you. The more experienced traders typically prefer the ECN model, which is the one that we see here, spread plus commission. The newbies and people that like to keep things a little bit simpler, perhaps, typically just go for the Classic version here. Okay, but it really is up to you. And then once you've done that, first name, last name, so then you'll get the login details emailed to you, and straight away you can jump on to the web-based platform or download and install the desktop platform, and you can start placing trades. Now with this, I'm going to explain some other concepts here. One of the other options you have here is leverage, in addition to your base currency. So with the actual leverage amount, what that relates to is the margin required to take out a trade. So let's put some of the concepts that we talked about before in practice. So here we have an account with 10,000 AUD, just over 10,135. And let's say, for example, we wanted to go and purchase half a standard lot, which would be 0.5 or 0.50, doesn't matter. Okay, so to put that concept in practice once again, let me see if I can zoom in here a bit. So thinking back to the metrics that we had before, the rulers, that is your base quantity of one standard lot. But of course, you can have any quantity you want down to 0.01. It's completely up to you. But just make sure that you understand the risk and make sure that the quantities that you're trading in conjunction with your stop losses and your profit targets, your risk to reward ratios, and all these good things, make sure that it fits in with your overall trading strategy and risk profile. But that's it there. That's the smallest quantity there, 0.01. For the sake of this example, we'll go and take a trade of 0.77. Why not? This is just a demo account. Zooming back out there. And so at this point, all you do is you just go and hit buy if you think it's going up, or sell if you think it's going down. The time you got in, whether it was a buy or a sell, the size, the quantity, 0.77 once again, euro versus US dollar, the price that you got in at. This is your stop loss. This is an order to automatically get you out of the market if it starts going against you. Your take profit there is an order to automatically take your profit if it starts going in your favor. The current price of the market, and this, because I set this up as an ECN account, has a commission component there. So in this case, once again, because Fusion has the best, just about the best rates you'll find anywhere, certainly the best advertised rates in Australia, you've only paid $3.47 in commission for that $77,000 trade. Okay, the swap rate relates to your overnight holding fees. Also very, very competitive, but it's something that we'll save for another presentation. And this is the profit on the trade itself, And this bottom row here, the bottom line, is the overall profit on all of your open trades. We're going to talk about leverage in some of the upcoming sessions in a lot more detail. It's a crucial aspect of risk management, and also, of course, in having the ability to take advantage of trading opportunities that you see in the market. So it's a very, very powerful tool. Powerful means that it can do great things for you, but it can also, if it's not used wisely, carefully, sensibly, and knowing what you're doing, it can also be, of course, detrimental to you. Now, the key leverage to consider when you're trading the markets is actually the total value of your trades relative to the size of your account, and also the pip values relative to your actual base currency on your account. Now that sounds complicated. Yes, it is. It takes a bit of getting used to, but you can see here that you have different leverage amounts available to you, one all the way up to 500. And so you just select an amount there according to how aggressive or conservative you might be in your trading system and according to your risk profile. And that's basically it. All right, I think we've covered that one. That's how you get started. Now, we're coming to the end of the presentation here. So once again, if you are looking to get started in the global currency market, Fusion Markets really has been formed for this purpose of providing low-cost trading, friendly support, and leading technology. That is the Fusion formula. So if you do want to give things a go, fusionmarkets.com, get yourself a demo account, get yourself a live account, or reach out. So just below the video, you'll find some more links for that, as you'd expect. Other than that, thanks very much for coming along. We hope to see you at a future presentation. As always, we wish you successful trading and investing. So bye for now.